Hi everyone, welcome to our July 2026 investment webinar. We're going to take you through a market recap, our views on the economy, stocks, and fixed income. As usual, I'm joined by Jordan and Tom. So to start us off, I'm going to turn it right over to Jordan for a market recap.
Thanks, Matt. So the stock market gave investors plenty to cheer for in the second quarter. For example, Exhibit 1 shows that stocks rebounded significantly, erasing first quarter losses arising from the Iran war and pushing year-to-date returns solidly into the green. Even better, these gains came primarily from strong earnings growth, with valuations less expensive today than starting the year. While encouraging to see strength broaden beyond the grade 8, with the average stock beating big tech so far this year, it's important to note that returns do remain heavily concentrated in the AI trade. For example, Exhibit 2 shows most gains came from a small group of cyclical tech stocks supplying hyperscale cloud companies with key infrastructure for their AI builds. That group, only 6% of the market, has more than doubled this year, contributing most of the index return, with the other 94% of the market up a more modest 3%. It's clear that AI is impacting markets, and I'll touch on more of that later. But first, I'll turn it over to Tom to discuss the macro and policy landscape, which are also being influenced by AI.
Thank you, Jordan. One of the areas that's really underpinning the stronger equity markets is a solid economic backdrop. And whether we look at things like the leading economic indicators, the Citi Economic Surprise Index, most of the data we're parsing through suggests that the economy is in solid footing. And so what we show here is GDP growth, and we break it out by the subcomponents of GDP. So what you see here is the two main drivers of GDP growth over the last few years have been consumer spending and also tech-related private investment, which is really driven by AI spending. And what you can see here is the consumer, when you put those two together, we call that core GDP growth, is about 2.3% this first half of the year. And actually, the current quarter is around 2.6% for those two combined. So pretty strong. The consumer benefiting from tax refunds related to the One Big Beautiful Bill Act and AI spend driven by corporate CapEx. Now, there are headwinds to both areas. So for the consumer, we remain very vigilant watching oil prices, which are moving up and down with great volatility related to the ongoing conflict in Iran. And on the AI side, we have Exhibit 4 here, which is one area we're watching, which is data center pushback. Now, underpinning the infrastructure for AI are the build out of data centers. And what we see here is a recent Quinnipiac poll shows that there is bipartisan opposition to building out data centers in their communities. In fact, 67% of Democrats, 66% of independents, and 56% of Republicans polled said they're opposed to building an AI data center in their community. We think this is going to gain steam, and we're seeing it at the state level right now. States like Texas, even Virginia, which has the largest data center population, are starting to push back. And most recently in New York, Governor Hochul actually put a moratorium on new data centers that require more than 50 megawatts of power. So that growing opposition could create an issue for AI and the build out, at least the speed of the build out, which we're going to be watching closely. But as I mentioned earlier, one of the things that we're also watching related to the consumer is the fact that interest rates have moved up. That's also a headwind to the consumer. And to dive deeper into that, I'm going to turn it over to Matt.
Thanks, Tom. Definitely interesting things going on with the Fed, despite Fed funds being unchanged for all of the first half of 26. But to jump right in, let's look at the slide on the left side. The green line shows the number of rate hikes expected by the market for the year, and the yellow shows the price of crude oil. So you'll notice that expectations were for multiple cuts early in the year, and the market moved to expect a hike as oil prices spiked towards the end of Q1. This is totally logical since rising oil is seen as inflationary, and that works against the Fed's mandate for price stability. This relationship totally broke down in the second quarter as expectations for hikes continued higher, even as oil dropped on ceasefire discussions. We attribute this to the market being surprised by commentary and tone from the new Fed chair, and rather than being eager to cut rates, Fed Chair Warsh has emphasized a commitment to price stability and plans for a thorough review of key Fed procedures and data inputs. So this actually all drove a lot of the price action that we're seeing on the other slide on Exhibit 6, the other chart. This is showing the U.S. Treasury yield curve at the beginning and end of the second quarter. You can see clearly that the yield curve flattened. Long-term rates were little change, but short-term rates increased to reflect different Fed policy path. United clients benefited from positioning in long-term municipal bonds, which held their value relatively well, given the fact that long-term rates did not change very much. And while corporate credit spreads generally remained tight, we noticed some weakness in preferred stocks and took the opportunity to add exposure, bring a little more yield to clients' portfolios at United. So that's our take on the bond side, but I'll turn it back to Jordan for our views on stocks and fundamentals.
Thanks, Matt. So today's markets are supported by strong fundamentals, with year-to-date gains driven overwhelmingly by earnings growth. That said, some of those fundamentals are starting to look a little bit stretched, especially around AI. For example, profits from AI are contributing meaningfully to market returns. Exhibit 7 charts the evolution of profits and cash flows for the AI complex since the launch of ChatGPT, and has highlighted the hyperscalers, companies like Amazon, Alphabet, Microsoft, Meta, and Oracle, are generating pretty strong earnings growth. Further, their significant and still growing investments in AI, as seen through growth capex, has been a key driver for profits and stock price performance for their suppliers. This includes cyclical tech industries like semiconductors, hardware, and equipment. That said, it's also important to note that hyperscalers' cash flow has not necessarily kept pace with their earnings. As shown, since peaking in 2025, the cash flows are now trending down toward break-even territory owing to that ramping AI investment. Now, this dynamic adds a new layer of complexity to the AI build-out. Having previously relied on internally generated cash flows, hyperscalers are increasingly turning to outside capital to finance the next leg of their AI ambitions. And as we detail in our newsletter, this makes the current pace of AI investments and the resulting market strength increasingly dependent on the market's willingness to finance it. So to that end, we are monitoring hyperscaler valuation multiples and credit spreads as a gauge for the market's appetite to provide further financing. Now, to be clear, we believe AI will ultimately prove to be a transformational technology, warranting a long-term allocation in diversified client portfolios. To that end, hyperscalers have a long track record of investing capital wisely, suggesting today's AI spend will at some point generate tomorrow's future cash flows. That said, it may take time, and it's common for secular tailwinds to hit air pockets along the way. For example, as we also detail in the newsletter, semiconductors have long been cyclical, with profits rising and falling alongside the ebb and flow of tech investment cycles. And as per our estimate, it's also important to know that this AI complex has grown to nearly half of the S&P 500, making the index an increasingly concentrated bet on AI. So with all that said, and while we're still optimistic on AI long term, we continue to favor a more diversified allocation, not overly reliant on it. This is especially true as the opportunity set outside of the AI complex improves. For example, Exhibit 8 charts earnings and market capitalization for the rest of the stock market, excluding that AI complex, highlighting that the recent real acceleration in earnings growth we're seeing more broadly for the group. And this is happening despite valuations for the rest of the market that still remain relatively reasonable. So said another way, there are plenty of opportunities in the market for complementary investments that may hold up better should AI leadership experience volatility at some point. So with that said, I'll turn it back to Tom to close this out.
Thanks, Jordan. Well, as you can see from both Matt and Jordan's comments, along with mine, there's a lot of information and a lot of data that the investment team is parsing through in making our assessments and also how they reflect in client portfolios. Just circling back to the letter, we finished the letter on a discussion on planning, and it's really this quarter we discussed diversified tax strategies around saving, spending, and planning. If you want to get into that in a deeper way, we would encourage you to reach out to your advisory team here at United, and we can map out a tax strategy plan. We're going to discuss the election, the November election, in more detail in the next quarter. And so we thank you for your time and attention and look forward to seeing you again next quarter.